Give us a sense of where we are in commercial real estate. Have we seen the bottom?
Thank you, David, for having me on the program. You know, if you take a step back, we've had 2 really difficult years for commercial real estate, and there are really 2 reasons for that. One of those is a historic increase in rates, which put downward pressure on valuation multiples for real estate. The other thing that's happened is office buildings have faced a lot of pressure, and the combination of that has resulted in negative headlines and negative sentiment. And frankly, those headlines will continue to be negative because you're still going to have stories of banks dealing with loans that they made in a different environment at a different moment when rates were lower. Sponsors, owners who maybe did deals in a different rate environment. But from our perspective, that's all priced into asset values today. And in fact, when we look forward, we see something very different. What we see is a generational investing opportunity, buying opportunity, while others are looking in the rearview mirror. And what we believe is happening is that values are bottoming. And the reason for that is, number one, interest rates. Inflation is cooling, rates have come down from their October highs from last year, and credit formation is once again happening in real estate. All-in borrowing costs are down 200 basis points over the last 5 or 6 months, and transaction activity is picking back up. The other thing that's happening that I think is underreported is this idea of new construction, which is down 30 to 70% in our core sectors versus 2 years ago. And I think that in the medium term will lead to a sharper recovery than the market likely expects. And then the third thing I would say, which is critically important, and we've been saying this for years, is where you invest matters. There's a huge bifurcation across asset classes. We all know what's happening with office. Values are under pressure, rents are under pressure. In fact, US office represents only 1.5% of our global portfolio because we were nervous about office. On the flip side, look at data centers, which are our fastest growing asset class. 2% vacancy, 25% rent growth, 10 times the demand that we saw only 5 years ago. And the AI revolution is just getting started. So for us, it's all about understanding the difference between the winners and the losers and doubling down in the places where we see more growth.
We hear a fair amount about warehouses with e-commerce, and especially now data centers with generative AI and the expectation we're going to need a lot more data centers. Are people already rushing into those properties that make it less attractive to you?
No, it's interesting. It's actually quite the opposite, which is to say that in both data centers and warehouses, for example, the fundamentals from a long-term perspective are as attractive as they've ever been. Yet there's a shortage of capital pursuing these opportunities. There's a shortage of liquidity in the system. So even as debt capital is coming back, there's still quite a bit less competition today than a couple years ago. So when I think about data centers, for example, this is an asset class where we took a view a few years ago that the combination of digitization of the economy, the cloud, artificial intelligence would all result in a greater demand for data centers because all of this data that's being created needs to be housed inside servers, inside data centers. And what we see on the ground is that the major technology companies have announced that they're going to invest $1 trillion of capital into their digital infrastructure over the next 5 years. That's going to drive more demand for data centers. And yet, very few people can capitalize on this opportunity at a moment like this because you need scale capital. Data center developments used to be $100 million. Now they can be as big as $1 billion, $2 billion, $3 billion. Very few people have that kind of capital. The other thing you need to have is a large land bank. You need to have access to power, which takes years to procure. You need to have relationships with the major technology companies. And so what we've done is we own a platform that we bought 3 years ago, QTS Data Centers. It's the fastest growing data center company in the world. We've taken that development pipeline from $1 billion only 4 years ago, 3 years ago, to today, $18 billion. We've grown the installed capacity by 6-fold over this very short period of time. And we still think we're in the early innings, but again, not anyone can do this.
Do you at Blackstone, do you think, have a comparative advantage in capital, access to capital? Because we hear about a lot of big players, particularly private credit is really all the rage right now. But do you have a comparative advantage in your access to capital that you can deploy quickly?
I think we certainly do, and I think that's really one of our calling cards. Today we have this unique privilege of having $65 billion of dry powder across just our real estate complex. And that puts us in a really unique position to do things that other people can't, particularly in moments like this when capital is short and hard to come by. As you know, we raised a $30 billion global opportunistic fund, which closed last year amidst all of this volatility. And I think the reason we were able to achieve that kind of a fundraise is that we have a track record of delivering through cycles. We've done it for over 30 years. Through that strategy, we've produced a mid-teens net compounded IRR on over $100 billion of capital. And our investors tell us that they want to concentrate their capital with their best managers. We're one of those folks. And what that enables us to do when you have this kind of capital is move with speed and certainty and take a long-term view and get deals done when other people are nervous.
And what about access to further capital? I mean, you tapped into the retail, if I can put it that market, through BREIT. Which had some adverse publicity for a while. You've got some good news on that, actually, now. Where are you with BREIT?
We could not be more proud of what we've done with BREIT, how we've built it. And it starts with performance. Since inception over 7 years ago, BREIT has produced an 11% net annualized return, which is twice the return that's been produced by the listed REITs during that same time period. And the reason for that is we own assets in fast-growing sectors. Warehouses driven by e-commerce, data centers driven by AI, rental housing. And at the same time, the portfolio is in the Sun Belt, the fastest growing part of the country. And I'm really pleased to report, as it relates to redemptions, that in the month of February, we paid out 100% of redemption requests. And all customers who have sought liquidity from BREIT since inception have received it. And in that respect, BREIT has done exactly what it was designed to do, which is offer premium returns, a higher rate of return in exchange for a measure of liquidity. And the reason we've been able to do all of that is because BREIT was structured the right way, a semi-liquid vehicle that is not a forced seller of assets. We own the right real estate with strong cash flow growth, and we manage the business with ample liquidity. And as we look forward with BREIT, why we're optimistic, among many reasons, is simply that the deployment opportunities are getting more interesting in this moment of volatility. We're not waiting for the all-clear sign to deploy capital from BREIT, and we've got some really exciting transactions that we've recently done and that are in the pipeline.
So talk about geography for a second. And particularly, you mentioned Europe earlier. Europe has had its share of troubles economically in terms of growth, in terms of inflation, things like that. What opportunities do you see for Blackstone in real estate in Europe?
Sure. I think sometimes people are surprised by the fact that our most active region globally has been Europe in light of a sort of nominal backdrop GDP growth that's been quite flat. But what it turns out is that sentiment is so negative today and liquidity is so short that you have folks who need to raise cash. And so we've been buying from groups who, for whatever reason, are willing to part ways with high quality assets in this moment. But we're buying at prices today that don't require us to believe a V-shaped recovery. And so just as one example, we're acquiring warehouses throughout Europe. We've acquired 4 billion euros of warehouses in only the last 12 months. And what we see is deep value. And as we look forward, we think that buying opportunity in Europe continues, because there are very few folks who have the scale that we do who can compete with us across the continent.
So to be clear, your investment in real estate in Europe is not necessarily a bet that Europe's going to come roaring back as an economy. You think it can sort of, I'll put my words, not yours, muddle along, and still you'll get a return on your investment?
Indeed, that's exactly the premise of what we're seeing in Europe. It's that you don't need to believe in a sharp economic recovery. What you do need to do is take a long-term view based on supply demand and based on value, and be aggressive in a moment like this when everyone else is nervous.